This is going to be kind of fun. If you know a little bit about credit spreads already, I think you're going to learn some things that are new and kind of exciting and kind of some great ways to make money with a little bit less risk and less stress. And if you're not, I think this will be a really great eye-opener for you, especially if you're trading right now and you're doing that kind of standard directional trading, whether it be in Forex or futures or options or even stocks, where you're really excited as long as it's going in your direction, and then when it reverses, you get the big anxiety attack. And so this is just going to be a little bit more relaxed, a little bit better way to make money that I think you're really, really going to enjoy. So let's get started. I'll introduce myself real quick. This is me. I'm the president of Cashflow Heaven Publishing, and we publish several different financial trading letters and strategies. And the one that I actually write myself is called The Winning Secret, and that's what this one is about, and it's dedicated to selling strategies and particularly credit spreads. So let's kind of get into it. I want to be respectful of the amount of time we have. This is an income strategy that builds wealth, so it's kind of the best of both worlds. So I'll show you how it can actually build quite a bit of wealth for you. Most people think of it as just income, and income's really important to pay the bills and to see your account grow over time, but it can also build quite a bit of wealth. But before we get into the details, let's take a look at why we're doing this strategy in the first place and what's your reward for learning something new. I don't know about you, but my brain gets pretty full sometimes, and sometimes I don't want to learn anything new, especially if it looks really complicated or weird, or I'm not quite sure what the reward is. So let's just take a look at what we're doing and why we're doing it and why this is something you might want to take a really good look at. So what's your reward and what's the potential? So if you learn how to bring in enough income that's not based on your labor, you will be financially independent. And once you understand really a good system for making that kind of money, you can be financially independent for life. One of the really cool things about the internet is you can be financially independent for life pretty much anywhere in the world. You can get an internet connection. So if you're a little tired of the cold winters where you're at, you can trade someplace warm and balmy, and vice versa. If it's too hot where you're at in the summer, go someplace where it's comfortable and see this beautiful world and trade while you're doing it. But I'm kind of preaching to the choir because we're all already traders, and I assume you're already trading to become financially independent. So how is this different than any other trading you're already doing? What's the advantage? Why should you even look at this? What's in it for you? There's two really, really big significant differences. And the first is your likelihood of winning. So this is kind of an interesting subject because new traders focus on how much they're going to make. Now, this is especially true if you like to trade something that's leveraged, like Forex or futures or options. And you look at, a particular move that the underlying made, and you go, oh my gosh, I could have doubled my money, I could have tripled my money. And then you go, gosh, if I had $10,000 in that trade, then I'd have $20,000 and then $40,000, and pretty soon, I'm going to be right up there in the ranks of the rich and famous. And that's a really, really fun thought process, and it's one that we kind of all do when we're new. It's the most natural thing in the world. And after you've been trading for a while, and after you've lost your pants once or twice, and maybe your shorts along with it, you kind of go, I kind of got to take a little different look at this. What should I do? And your likelihood of winning starts becoming a lot more important to you. And that's why, as traders, as we advance along, we look at technical analysis, we learn some new things, because we're always trying to increase our probability of winning. So experienced traders focus on their probability or their likelihood of winning much more than how much they can potentially make. And if you get a high enough probability, you pull the trigger. It's true for all of us. If you look at our trading, you go, you know what? This thing has a really good chance of working out. We really want to tend to do that trade. So in this presentation, you're going to learn how to create an 80 to 90% mathematical expectation of winning on every trade you make. And I don't know where you're at on the continuum of probability, but I'll tell you what, 80 to 90% probability is pretty exciting, because mathematically over time, you're going to win most of the time. So the second big difference is the ease with which you make your profits. Now, if you sold options before, you know that your goal is for whatever you sold to have a worthless expiration, and you sold something valuable, and if it expires worthless, that means you keep all the money. It stays in your account. So most of the time we have to do absolutely nothing to win, and we have to do nothing to make time go by. It happens all by itself. And so when you're an option seller, you're basically a time merchant. What you're selling is time. So your trades are all stacked so heavily in your favor that in almost most cases, once the trade is entered, you don't need to do anything to win. It happens automatically with or without you. So typically what we're seeing, the way we set up our trades, and I can show you exactly how to do this, and I'll show you in this event right here, is only about 2 positions out of 10 will need some adjustment. Not too many. And this strategy, now why does it work so well? Why does this strategy work so well? Well, as we've already talked about, it's an option strategy. Now, trading options the way most people do it can be challenging. Most people buy options on a stock they think is going to really move in their direction with the intention of making a killing. And if you've done directional options trading, you know what I'm talking about. And I still do directional options trading. If you get a really big move, you want to make just a ton of money really, really quickly. In fact, you want to make a killing in the market. And a killing is often what happens. Unfortunately, it's not always the way people were hoping. There are many estimates as to the percentage of options that expire worthless every month, but most come in somewhere around 85%. And so I want you to think about that figure. The vast majority of options, 85% of them expire worthless. Now, if you research this on the internet, you'll see arguments both ways. Like the CBOE wants to say, well, a big percentage of options, get that bought back before they expire worthless, so they don't really expire worthless. But the truth is, and here's something you can take to the bank and absolutely depend on, is by the time expiration rolls around, 100% of the time value of that option has expired. It's, there's no time value left. So here's another thing to consider. According to the Options Clearing Corporation, over $1.2 trillion worth of options were traded last year, and this year is projected to be even higher. So the interest in options keeps increasing. People like them for hedging their stock accounts, and they like them for out and outright speculation, and more options are getting traded every year. So if 85% of options expire worthless, where does all that money go? And when I first got started trading options a long time ago, and I would buy a call or a put, and my option would expire worthless and I'd lose all my money, I would say, gosh darn it, I've lost all my money. And it was a little bit of a revelation when I realized that in the options market, no money actually gets destroyed. It just changes hands. So when I realized how much money I was losing trading options, and how much everybody else was losing trading options with this 85% of options that expire worthless, I started thinking, there must be a huge pile of money somewhere, accumulating somewhere. Where does all that money go? How do I access this huge vault of money? And the money goes to the option sellers. Those are the ones that are collecting all the premium that gets lost. So it's estimated that there will be about 1.4 trillion worth of options bought and sold this year. If 85% of them expire worthless, that means there will be an astounding $1.19 trillion worth of expiring options premium this year alone. So to put that number in perspective, that's $1,119 billion worth of premium that option sellers are going to keep just this year, and that number keeps growing every year. So, look at that figure and try and wrap your mind around it a little bit, and then ask yourself, how much of a slice of that 1.19 trillion do you need to be doing very well? And it's a very, very small slice. So there are some powerful reasons to become an options seller, but what kind of an options seller should we be? There's covered calls, and that's where you buy a stock and then sell options against it. That's a great strategy, like that strategy. But it takes a lot of capital to buy the stock in the first place. So your rate of return is a little bit lower. Some people sell naked options, which can be extremely risky and really not appropriate and not that great of an income strategy when it comes right down to it. So what we're left with here is credit spreads. And credit spreads, the more you get into them and you realize the changes that they've made in the last few years, you realize how exciting credit spreads can be. A credit spread is where you sell an option to collect a premium and then sell an option further away from the stock to hedge. So here's the concept right here. We take something that is going up. And let me just see if I can get a little pen here and do some drawing. So as you can see, this is a little white dot. So what do we have here? There we go. So here's our pen. Ooh, we can see that we've got an uptrend here. And that's an uptrend that's easy to see, it's easy to follow, and we can see that, you know, it's probably going to keep heading in that same direction, keeps bouncing off support. Well, all we do is we sell underneath that. Here, let me grab a little arrow here so you can see that. We sell the 1775 puts, and we don't want unlimited risk here because we have liability all the way down to zero if we just sell the 1775 puts by themselves. So we go just underneath it and we buy the 1770 puts to hedge. So our only liability is the distance between the two strikes, or $5. Now the difference that we get in credit, we sold the 1775 for $5.20. We buy the 1770 for $4.70, so that's a 50-cent difference. And let's see, we sell the 1775, we buy the 1770. The difference is 50 cents. Okay, so if we take 50 cents, remember our liability between these two is $5, but we already got 50 cents. So the maximum that we can lose if this stock just completely rolls over and plunges all the way to the downside, which we don't think it's going to do, but if it does, the max we can lose is the $5 minus the 50 cents that we already got. So the maximum that we can lose is $4.50. So you divide 50 cents divided by into 450, and we get an 11% return. So this right here, you can see this time distance here. This is only for about 3 weeks of time. Now let's just analyze this a little bit and take a look at our probability just based on common sense. So there's only 5 things that a stock can do. It can go up dramatically. If it goes up dramatically, it's going away from our spread, and this spread will expire worthless and we'll get to keep all the money. It can go up a little bit, kind of in the direction that it has been, in the direction it's likely to go. And if it does that, this spread will expire worthless and we'll get to keep all the money. The stock can just start trading sideways. And you can see it's kind of been doing that here for a few days. If it just keeps trading sideways, this spread's going to expire worthless and we're going to keep all the money. Or the stock can kind of roll over and go down gradually. If it goes down gradually, this spread's going to expire worthless. That gets threatened is if it rolls over and goes straight down. And if it does that, we've got a lot of ways that I can show you to counter that move and come out just fine. But chances are really good, essentially 4 out of 5 chances that this is just going to go to expiration, and that's the finish line right here. That's this particular Friday. And if the stock finishes anywhere above these sold strikes, or this sold strike at 1775, we're going to keep all the profits. We're going to keep our 11%. So an 11% return for 3 weeks of time is pretty good. And you can get rich with those kind of returns. So if you want to do something really fun, either doing this presentation or after the presentation, get out a calculator, take whatever amount of money you'd like to dedicate towards this strategy. Let's just pick a number, 5,000, 10,000, whatever you want to do, and get an 11% return every 3 weeks of time with very few losses, maybe 1 out of 10 you might lose a little bit on. Figure out what your rate of return or what your money's going to turn into over 1, 2, or 3 years with the compounding effect. So for you big time traders that like to double and triple your money overnight, you might say an 11% return for 3 weeks. I give that a big yawn. I don't care. That's not enough money for me. With this probability of winning, you can turn a relatively small account into a pretty darn big account in a surprisingly short amount of time. And that's an excellent rate of return, especially compounded, but can we do better? And I think we can. What if we could double our returns while keeping our probability of winning the same? So one of the things that we can do in selling credit spreads is we can go up above, outside of what we think the stock's range is going to be, and we can sell another credit spread up at this point. So say we sell the 20 and buy the 1890 calls to hedge for $1.70, and the difference is, once again, 50 cents. Well, we got 50 cents down here and we got 50 cents up here, so that's $1. So now the most we can lose is $4. So $1 divided by $4 is, now we're getting a 25% return for the same period of time. So up here, and the likelihood of it getting all the way down here are actually similar. So we haven't increased our risk much, but we've doubled our rate of return. And when we do two of these here, a credit spread down here is called one wing, and a credit spread up here is called another wing, and these two big wide wings form the wings of, like a bird, so they call it a condor. So this is called a condor. So a 25% return for just 3 weeks of time is huge, but what if the trade goes against us? Now, one of the things that happens in a lot of these presentations, and I love webinars, I love to listen to other traders, but typically people like to talk about, need to get excited about new strategies. But I think whenever you're taking a look at something new, I think it's really important to take a look at the risk. So what can go wrong? What happens if the trade goes against us? No matter how low a likelihood of that happening could be, what happens if the trade goes against us? So let's just say, it's been going up on this trend for months and months and months, and we think it's going to continue, but what happens is it rolls over and it just goes straight down and wants to go through our two strikes. So what we do is when the stock starts approaching this level, and you can see that we've got a couple levels of technical support here that indicate we may have a new trend. So if it breaks this horizontal, like it's going to be going down. If it breaks this uptrend support here, it looks like it's going down. If we keep waiting and we don't acknowledge that, if it breaks this level of support here, it's probably going down. So we've got a lot of opportunities to close this threatened spread before the stock gets there. But it'll always cost us money to close, so we want to offset that, and we can. So we go ahead and close this spread. We open a new spread up here, and we open a new spread down here, and we take in enough money to either offset this or actually even profit from having to close the threatened spread. This is called rolling, and you can roll out to the same expiration. In this case, you can roll out to a further expiration if you need to get a little bit more credit, but it's a fantastic strategy to bring in more money. And I'm just kind of glancing at the comments down here, and it says, Phil says, what about commissions? Well, commissions, of course, are super, super important. But what I like to concentrate on is, are you making money or not making money? So, each one of these legs here, each one of these lines entails a commission because it's actually a trade. But if you can do this rollout and actually make money on a trade that's going against you, I would say commissions play a relatively minor role. And I'll show you actually how to reduce commissions right here in this presentation. But and so that's a good question, Phil. So I get the biggest kick out of this picture, and we've all kind of felt this way when we've been trading in the markets. So if you're really a skeptical out there, and maybe you've been burned on credit spreads once or twice, and you're going, yeah, but what about disaster? What if disaster strikes? What happens if the stock gap's big against us, and we don't even have the luxury of seeing when different horizontal support levels are broken? What if it just happens all at once because some big disaster gets announced in the market? What do we do then? What's your strategy then? Well, here's a great example. It's really fun to talk in the theoretical, but I think it's even more fun to talk about real world examples because they're a lot more relevant. So here's a trade we actually put on back in November. Unfortunately, this doesn't happen too often, so I had to go all the way back to November to find a trade that really blew up against us. So this is a company called CF. They produce fertilizer, and the company is rising in a gradual up. So this is, we have a trading letter for credit spreads, and this is the actual verbiage that I had right here on the chart. that I showed everybody to set up this trade. So CF is rising in a gradual uptrending channel, which we'll be selling well outside of for some generous high odds premium. So this, this looked really safe. So we're going to sell a call spread up here. We're going to sell a put spread down here. The thing is in this channel, it can wander all over this channel. It's got a really nice, close to a 20 point range that the stock can wander around in, and we're absolutely safe. And where we've got the finish line just about 4 weeks out, and this just looked like a super good trade. So if you've ever been trading and you see just a setup that looks super, super good, there's a strange thing that happens once you get into it. Oftentimes you'll see the trade fall apart completely, and I've often subscribed to the theory that trades go fine right up until we personally get into them, and then all heck breaks loose. But let's see what happened with this one. Oh my gosh. We were in this trade just about 4 days, and they announced that they're considering turning into an MLP structure, which people absolutely love now because MLPs pay out all these disbursements in cash, and everybody's chasing income, and everybody just loved that. The stock gapped up over $30 in 1 day, rocketing right through our spread. So if you're this, or even if this is the first time you've ever looked at this, and you see that disaster is when a stock goes through your 2 strikes here, would you agree that this is about the worst thing that a person could possibly happen to a trader when they had a spread on? I mean, how in the heck do you recover from this? And so here's what we do. We set up automatic orders that in the off chance that this is to happen, our strike or our spread is closed, either right here at the sold strike or a little bit before it. So when it gapped up this morning, or the morning that this happened, it rose up, and the minute this trigger got hit, this spread was closed. Now, it cost a bunch of money to close the spread, but it was absolutely cheaper to close it right down here at the sold strike than to wait till it's all the way past it. So that's what happened. We closed the spread, cost us a bunch of money. So now we're negative on the play. So what do we do next? So what we did, and I don't know if you can see down here, here's CF, here's our, up here, here's our original two wings, and then down below, here's the wings that we put on afterwards. And right here, you can see that we ended up somehow, some crazy way, making 9% on this trade that went totally against us. So let's see how that happened. So what we did is we closed out, obviously, this call spread right here when the stock gapped up, and then we opened 2 more spreads. We opened a call spread way up here in green that you see, and we opened a put spread down here in green, and we brought in some more money. And look, we were able to do it at the exact same expiration, so we didn't have to tie our money up any longer for any longer period of time. So we closed the top spread for $2.20. And we also closed the bottom spread, the one down here, for just 10 cents because we wanted to free up the margin on that trade to put on 2 new spreads. So then we sold our 2 new spreads for a combined $1.74. So our total credit was we got 85 cents the first time we put on those spreads. We got $1.74 the second time, and it paid a lot more because there's a lot more volatility. So we took in a total of $2.59. When we had to close this spread right here, when the trade went against us, it cost us $2.30. $2.20 for the top spread and 10 cents for the bottom spread, so a total of $2.30. So if you subtract our cost from what we brought in, you'll see that we netted 29 cents on the trade, and that's a gain of 9% total on this trade by the time it expired worthless. And once again, you might say, well, 9% isn't very much money. Well, I'll tell you what, it is incredibly, infinitely better than losing money. And with most trades, when they go against you, especially when they go against you dramatically and you are just totally wrong and you just end up with this big pie in the face, traditionally, when that happens in the markets, we lose money. So one of the reasons I just absolutely love this strategy is about 8 times out of 10, you're just going to win while snoozing on the couch. But the 2 times when trades really do go dramatically against you or even a little bit against you, there's some really wonderful ways that we can tap dance out of the situation. And I just love the forgiving nature of this strategy. So the beautiful thing about credit spreads is you have options. It's a little bit of a play on words, but it's just so true. There's almost always something we can do to make a trade better. And that's one of the big takeaways I want you to take away from this credit spread strategy is there's so many ways to defend against a trade gone bad, and there's so many ways to come out smelling like a rose when in any other trading strategy you just wouldn't be able to. So speaking of making trades better, how can we improve our returns while reducing our risk? In other words, how can we create extraordinary returns? So, you know, the title of this webinar, and maybe one of the reasons you're here, is how to sell credit spreads for extraordinary returns. Well, where's the extraordinary returns part so far? Because up until now, we've just been talking about credit spreads and just in general how they work and how we can defend against them. So how can we create some really, really great money with credit spreads? So let's look at 5 strategies to reduce your risk, increase your returns, and increase your frequency of returns. So if you haven't been taking notes yet, this might be a really good time to do it. These are some really, really effective strategies for taking credit spreads from a boring sit-around waiting strategy into a really exciting high odds, high return strategy. So number 1, you pick the highest odds underlying. So picking what you're selling spreads against is super, super important. Most of the time we do indices like the S&P 500, like the Russell 2000, because you eliminate single stock risk. But there's times when you want to trade a stock. One of those times is right after an earnings announcement and the stock is really gapped one way or the other, and the volatility just spikes all the way through the roof, so you can get this just huge amount of money for selling way out of the money, you know, to a from where the stock is liable to get. That's what volatility affords you. But once the news is out, it's out. So a lot of the time you'll see a stock gap dramatically one way or the other, and then it just trades sideways for a couple of weeks, or it just gradually goes one direction or the other. So picking your underlying is really important. And some people stick to all stocks, some people stick to all indices. We can do both, but it's just really important to be selective about which ones you trade. And right around earnings season, you know, you never want to trade a credit spread before earnings are announced, but I'll tell you, afterwards can be a tremendous time to do that. So earnings season actually affords some really, really cool opportunities. Number 2 is sell outside the predicted range, paying attention to market trend and future events. So this is a great example here with the Russell 2000. This trade worked out really well. We made 22% in just 8 trading days by selling outside the stock's predicted range. And also look at events coming up. You know, maybe you don't want to sell your credit spreads right before a really important FOMC meeting or right before earnings are announced. So you just take a look ahead and see what's coming up, and you can sell before an earnings announcement. Just make sure your options expire before the announcement is made. So that's number 2. Number 3 is make sure your probability of winning is at least 80 to 90%. So we can sell options, a spread that is, you know, well away from the underlying, and kind of intuitively know by looking at the chart that, you know, this one has a really good chance of winning. But how do you quantify that? How do you get it down to some math so you have just a little bit more assurance that this thing's going to work in your favor? So fortunately, options are based on the Black-Scholes pricing model, and this is the pricing model that got the Nobel Prize for its creators back in 1998. They actually invented it or came up with it back in the early 70s. It enabled the modern options market as we know it, and then the Nobel Commission didn't get around to awarding the prize to them for applied economics until 1998. But what's really cool about this formula is that you can use it to really take a look at what your probability of winning is. And you don't have to know one bit of math to be able to do that. So Thinkorswim is my absolute favorite broker for trading options because they give you so much great information. And if you go up here and you look at this layout tab right up here at the top, there's a little drop down in the corner here, and you click on that and you can set up your columns any way you want. So the way I've set up my columns here is implied volatility, probability of being out of the money, and delta. So if you look at this particular spread we set up, so we set up this 1775, 1770 put spread, the one that I've been showing you on the chart, and we collected 50 cents for that. So what's our probability of winning? Well, you go down here and it's always strike that you sold, because that's the one that's closest to the underlying, that's the 1775. And we look out here to this column out here where your probability of being out of the money, and it's 83.96%. In other words, right around 84%. So that's a pretty good trade. I like that trade. And as time goes by, what we're selling here is time, so there's a lot of time decay. So theoretically, if all goes well, if the trade doesn't completely go against you, this 83.96% chance of winning will actually increase as time goes by and as time decay kicks in. But this is a really cool way right on your trading platform where you can see what your probability is of winning before you ever enter the trade. Number 4 is make time decay work harder for you. There's a lot of people out there that have been selling credit spreads and they sell 2 months or a month. Well, there were some changes that happened in the spring of 2012 for weekly options that make it so much easier to pick your expiration. Now, weeklies are super, super exciting. It's one of the coolest things that's happened to options in probably 20, 30 years since options were invented. And when they first invented the weeklies, they would create them on a Thursday, and then they would expire the following Friday. So you'd have, what's that, 5, 6, 7, about 7 trading days of time to be in that position. So what they did in the spring of 2012 is they started taking certain underlines like the SPX, the SPY, and, some stocks like Apple Computer that are really heavily traded, and they started creating weeklies that expire like 4 Fridays out. So you can literally now go and take a look at options change and pick the Friday where you want your trade to expire. So in the old days, it was just the 3rd Friday of the month, so that was your only choice. Now you can literally pick the spot on the time decay curve where you want to take your position. So here's a time decay curve, and what's really important about this curve for you to understand is that options do not expire in a straight line. There's a curve here, and the curve accelerates to the downside the closer you get to expiration. So I know there's people that sell options about 2 months out, and the reason they do is the time decay curve starts getting steeper, and then it really gets steep when you get into front month. The problem I have with that is you're tying up your money for too long of a period of time. Wouldn't it be nicer to get our money coming back to us in just a month? And as long as we're fantasizing and putting things on our wish list, wouldn't it be nice to get it in 2 weeks? And that way you could get 2 turns on your money in a month instead of just 1. So what we found, we're always, selling credit spreads is a little bit of an art, and you're always looking for the best spot on the time decay curve and trying to get just out of the money far enough to get a really good premium without ever becoming threatened by the underlying stock. So what we found is the sweet spot on the time decay curve is about 1.5 to 2.5 weeks. On average, we're in and out of trades. They expire worthless within about 2 weeks of time. So we can actually end up churning our money. And you can do this too. This is so unbelievably cool. You can get these rates of return twice in a month instead of once in a month. And once again, if you want to do something really cool and fun, get out a compound interest calculator and start figuring out how just even getting a modest rate of return twice a month is going to do to your money in a year or 2 years. So number 5 is get bigger credits by selling your wings at different times. So this is actually a trade that we have going on right now. So back here when the SPX was rising, and I thought it was going to go up, but I didn't think it was going to go absolutely to the sky. We sold the 1905, 1910 call spread for $1. So that's pretty good. So we're getting our 25% just on one wing here. And this expiration is 4/11, so that's tomorrow. This whole thing expires, and you can see we're getting pretty close to the finish line. Well, I figured, what? This is all we were going to do. We were just going to put on a call spread. Well, all of a sudden, last Friday, the stock market absolutely fell out of bed, and then Monday, it did another day where it just went straight down. Now, we have this really strong horizontal support going across right here, and, maybe we're going to have a big downturn coming at some point in the future, maybe after this earnings season or maybe this October. But, it just did not look like it was going to happen yet. I thought there was a really good chance we're going to get a bounce. So on this day right here where things looked really, really bad, we went ahead and sold the 1825, 1820 put spread And this we did just on Monday with just 5 trading days left, and we got $1 because the volatility was so high. So we just sold that. So we got $1 on the call side, we got $1 on the put side, so we got $2 divided by all that's left is $3 of our $5 that we could possibly lose. That's a 67% return. And this thing is due to expire tomorrow. So if you think of credit spreads as something you don't want to do because it's 5%, 10%, and you have to wait too long to get your money back, and all of those things that may have been true about credit spreads a few years ago, it's a whole new game now. It is so cool to be able to stack the odds so far in your favor and still be able to win such a really substantial amount of money. I mean, it's just really cool what's going on right now. Okay, so let's move on. So those are your 5. And so here's what we've actually been doing. So, I realize there's ups and downs in the markets. Your theories don't always play out when, there's big explosive moves and when the Fed is making these wild announcements that are kind of tough to game. So, we don't have our trades in for April yet because that's the current month, but I can show you March here. Here's one on the FAS that went against us. We rolled it down. We still ended up making 24% on this particular trade. And in a fairly short amount of time. You look at, this is 226 when we put it on. We're completely out of it by, well, even after the roll, we're out of it at 314. So this is just 20 days on one that went against us. We made 24%. Here's a standard one on the rut where nothing happened. The thing just expired worthless. Nice, quiet, sleepy trade. We made 23%. And that's 3.6 to 321. That's just 15 days. Here's one on the FSLR. It just gapped up really big. We needed to close our call spread, but we still ended up making 12% on the trade. These returns are really typical with what we've been getting, and our time frame is typically right around 2 weeks, oftentimes less. So once again, if you learned about credit spreads 10 years ago or even 5 years ago and think it's this, really conservative, low return strategy, boy, think again. It can still be pretty conservative, but your returns are getting better and better, and the amount of time that we're getting them in is shorter and shorter. I think is reasonable to expect. And what we're typically shooting for is 20 to 25%. That's really typical. But what do you, oftentimes we will, shoot for a little bit less if the market's getting really volatile. Sometimes, we'll absolutely want to hold money in cash and reserves for buybacks and rollouts, account being used at one time. So, what do you think is reasonable for a strategy like this to get in 2 weeks? Oftentimes we're getting around 20, around 25%, but let's say you have some losing trades. Do you think that you could do, consistently 20%? Do you think it's reasonable to expect 15%? Or maybe, you think, well, even the market is so variable, even if you're shooting for 25% on your whole account, you might just get 10%. Well, all of those would be fantastic rates of return, and we're actually doing, right in that range right there, depending on the month. But let's just reduce, just for this example, let's reduce our expectations down to a level where we all kind of agree it's pretty reasonably to expect that we could get, what's reasonable, 5%? Can we get 5%? I mean, we've been doing a lot better, but let's just say that, you're new to this. Let's just say all you can get is 5%, and we can do that every 2 weeks. So let's see what that looks like. So if you get a consistent 5%, that's figuring in all the rollouts aside, that's any losses that you might have. Let's say we're getting a consistent 5% compounded every 2 weeks. So after 1 year, a $10,000 account has more than tripled to $32,251. And you're bringing in, you're bringing in a little more than 10% because it's compounded. So you're bringing in about $3,200 a month on a strategy where you can really sleep at night, and the deck is really stacked in your favor, and you've got automatic orders to close spreads if there's an overnight gap or if something happens. I mean, this is the kind of strategy that you can do on vacation. This is the kind of strategy you can do when you have a job. It's really refreshing. especially if you're used to being a typical directional trader. This is over just 2 years. So after 2 years, your 10,000 has grown to 104,000, and you can see the incredible exponential growth of this curve here. That's compounding. Now, what I'm figuring in here is we're typically shooting for 20-25%, and I'm just saying, say most of our trades don't, or a lot of them don't work out, or we have to, buy things back, or things go really bad, so we're just getting 5%. Your $10,000 account in 2 years has grown to 104,000, and you're bringing in over $10,000 per month. So I just want you to know, now I understand, if you're a little skeptical, I understand that nothing ever gets a perfect 5% every 2 weeks. There's a lot of weeks where you're going to make a lot more than that. Maybe you have a really tough 2 weeks and you make a little less than that. I'm just trying to keep it really conservative and keep our expectations at a really, really believable level. So it's super important to me that you're successful trading this way. So I want to make sure you've got everything you need. So if you're a little bit curious about this strategy, I think that's fantastic. Even though I'm a little pressed for time here, I'm gonna set aside some time to answer some questions. And I see some questions that are popping up here on the bottom, and I want to absolutely answer those. But if you're a little bit in a time crunch, I want to give you the URL to go to for just an absolutely incredible offer we're offering on this. Here's the thing: is I have a belief, and my belief is if you get in there and you get started with me and we trade some of these together, I think you're going to be a believer for the rest of your life. And if you've been trading and you're looking, I honestly believe that these credit spreads are the answer, because they stack the deck so far in your favor. You're going to start having some victories, and that positive reinforcement, you're going to keep on going. So that's the URL, but I'm just going to tell you real quickly what you're going to get here, because you're going to get a lot, and you're going to get a lot for a little. So to make sure you have a really good understanding of how this strategy works, you get a complete video presentation called How to Trade Credit Spreads for Fun and Profit. And this starts you from the very basics. If you don't know anything about credit spreads, heck, if you don't know anything about options, you're going to absolutely love this presentation. And I make it really simple, really cool, and I think you're going to get really turned on to this strategy. So it shows you step by step how credit spreads work, why they work so well, and how they can work for you. Plus, I'll show you what to trade and how to trade it. So every Tuesday evening, I produce 2 high probability trades, and I'll show you exactly where to sell your spreads and exactly how to sell them for the possibility of maximum gains with minimum risk. And the letter is pretty extensive. I mean, there's a lot there. I talk about the market, which way the market's going to go, how it affects us. I show you our 2 new spread trades, why they're likely to win, what's going on with the stock, where to put your stop just in case things don't go the way that we think they're going to. And then I have a whole nother section down at the bottom that talks about our open trades. So if you have some trades going on already, I say, hey, don't worry about this one. It looks great. Or this one we might want to keep an eye on, and here's something we might want to do with it. So I really take you by the hand and show you what to do. And I just think there's no substitute for that. And I just love this. It's just an absolute passion. It's just so fun to do the research and pick these trades out and find things that are going to work out well for us. And I want to share that with you, and I do it with a lot of detail every Tuesday evening. And I'll also send you updates during the week if there's something that we need to take care of or something that you should keep your eye on. And I just send those right to your email. And even if you're out there walking around with your smartphone, if you want to get texts, I'll let you know when something new has been posted, so you can just log in real quickly and see it no matter where you are. If you have a smartphone, you can get these, or even if you can just get texts. So you'll also get how to maximize your subscription. So once you get inside the website, I have this whole thing on what to look for and how to use it. I really want you to understand it. I want it to be a fun thing for you. I don't want to make it too complicated. It doesn't need to be. We're really selling time and putting time in our favor. And so I really, tell you what to do and what to take a look at there. Plus, you'll get a video that shows how to get better fills on your condors on the thinkorswim platform. This will also actually just kind of show you, this video kind of shows you how to use the platform if you're not familiar with it. And by the way, thinkorswim is my absolute favorite broker to trade options. And if you go out on YouTube and you look at a bunch of options gurus and you take a look at what platform they're using, every single one of them is using thinkorswim, and there's a reason for it. They have the absolute best analytics. They give you some fantastic executions where you get filled right there in the middle of the spread. They're just great. And I'm even going to, give you a chance to get lower commissions at Thinkorswim to give you a really good incentive for getting on this really good platform. Plus, as an extra bonus, you'll get a 10-module video course specifically on trading the weeklies. So the weeklies are so unbelievably cool. They're just great. There's so many cool things that you can do with them to really put that time decay in your favor. And this 10-module video course has been so incredibly popular. We can sell this all by itself for $250. It's worth every penny. It's probably the most popular piece of educational material we've ever put out there. You're going to absolutely love it. Plus, you get a digital book along with it, just in case you'd rather read instead of watching the videos. So it's a really complete package, and I actually want to throw that in if you decide to come on board with us today. So I just want you to have a bunch of really cool goodies, and I know you're absolutely going to love this one. And whether you stick with us or not, or we've been buddies and long-term trading partners, it doesn't matter. I want you to have everything that you get here to keep. And this is the big clincher for opening an account at Thinkorswim. To make sure you have everything going for you possible, you'll also get a special link to open an account at the best broker in existence for this strategy. So it's been years and years of negotiating this, but here's what we've got. Once your account is open, but before you funded it, so you still have a little bit of negotiating room, I'll put you in touch with our contact at TD Ameritrade, and they're the ones that bought Thinkorswim, so they own Thinkorswim now, to get you special commissions rates set up just for this program. And what I pointed out Thinkorswim is that because we do credit spreads, so we have 2 trades for every trade we do, and with Condors we actually have 4 different positions, we trade a lot more contracts than the average trader, and therefore I believe we should get better commissions. And you know what? After working on them for several years, they actually agreed with us. And so if you come on board with us, go ahead and call our offices. Once your account's open, we'll get you in touch with TD Ameritrade, and they'll get you special, lower than advertised commissions at Thinkorswim. I can't tell you what those are exactly because that's negotiated based on the number of contracts you're planning on doing and so forth, but I guarantee that they'll be better than what you'd trade otherwise. David says, do Canadians get the deal on commissions? I'm not sure about that, but the good news is you can actually open an account with Thinkorswim because TD Ameritrade is actually in Canada as well. And Canadians have some limited options on options accounts. So the good news is you can actually get the platform. So a subscription to the Winning Secret is $97 a month, and people absolutely love that. Out of all the financial trading letters that we market and sell, people stay on the Winning Secret longer than any other. I mean, they just stay on for years and years and years, and the $97 a month doesn't bug them one bit because they make so much more money than that, and their probability of winning is so much higher. So I anticipate if you come on board, you're going to be with us for a long time, and I would absolutely love that. I'd like to hear from you. I'd like to get an email. I'd like you to tell us, how you're doing. It's really important to me. But for attendees of this presentation only, I want to give you an incredible incentive to get started, because I know if you get in there just for a month, you're going to absolutely love this. So I have this philosophy that I think any trading education that you get, if it's a really good education and if it's a really good subscription, it should pay for itself, and you shouldn't have to come up with any money out of your own pocket. So I want to let the market pay for your subscription and anything else you decide to get from us. And I know in a month, if you just do 1 or even 2 spread trades, the market's going to end up paying for your subscription for a very long time. So if you can just get yourself in the door for a month, I think you're going to be in really good shape. So if you go to this URL, www.profit-90.com, I've got a special coupon available for you, a $90 coupon code, so you can get that $97 subscription for your first month for just $7. And that $7 is just to pay the gals here in the office to process your order and get you in the system. And you have nothing to lose but $7 if you don't like it. If it's not for you, it's not your cup of tea, just get a hold of us anytime before your first month is over and just say, hey, it was fantastic, but it's not my deal. I want to cancel my subscription. We'll be happy to do that. If you decide to keep it, you don't have to do anything. You'll just automatically be charged the $97 on your second month and every month thereafter, as long as you want to stick with us. And like I say, people end up coming on board and they don't leave. And the reason they don't is because you typically win with these trades. And I just absolutely love that. So just to sum up, this is a train you don't want to miss. You owe it to yourself. If you're a little frustrated, if you just want a way to make money that isn't quite so worrisome, or you don't have to watch your computer so darn close, I think you're just going to absolutely love this. So, you know, you've got the whole thing here. You've got the URL right there that you can click on. And now, you know, I've just got about 2-3 minutes left. I just want to answer some questions here. Gary, fantastic presentation. Thank you so much, Gary. I really appreciate that. Yeah, a promo code is needed, and the promo code is, are you ready for it? It's profit in all caps -90. That's your promo code, and you just enter that, and that's how you get in there. Let me get back to some questions on the strategy. Can I use the strategy in my retirement account? Absolutely, Ronald, you can. You just got it. You have to get approval from your broker to use it in your retirement account, and your broker's going to want to know 2 things. Do you have experience trading options, and do you have the money to withstand a loss? And nobody's going to check your answers. You just have to put your best foot forward, and if you do, they are going to give you the capability of trading in your retirement account or any other account you want. Been there in the summer and it worked. That's fantastic, TE. How about a friend in Canada? Well, let's see. Nothing to lose except for $7. I'm just going through these as quick as I can because I'm absolutely determined that I'm going to finish on time. How about Europeans? Let's see. Yeah, RB says Interactive has one of the best commission rates, and Interactive Brokers is also good for Europeans and Australians, so I'd encourage you, if you want to do this strategy, you absolutely can with Interactive Brokers, so go ahead and go to them. They're also great. Fred Bradley says, any chance of getting the discounted commissions if we already have an account with Thinkorswim? Yeah, you know what, Fred? Go ahead and sign up for the program. We'll get you in touch with our contact there at TD Ameritrade, and he'll do the best he can for reducing the commissions that you're already paying. Okay, just looking at questions. Are you doing mainly iron condors or also bull and bear credit spreads? I'm doing them all. So whatever the market looks like, that's what we're doing. So listen, I'm winding down. I've just got about 20 seconds left here. So I just wanted to thank you for attending. I really appreciate you listening to this. I hope you come on board. It's so much fun to make money together instead of apart. And so I hope you take advantage of the $7 deal, because once again, I think you'll be a believer for life once you do this. So I want to thank you for being here. And Jana, I want to thank you and Morgan for having me. It's always a pleasure to be here. And I hope you enjoy the rest of the presentations, and I'm looking forward to having you on board. Thanks so much.
Thank you so much, Peter. I'm sure everyone